Live from Frankfurt ahead of today's European Central Bank decision, this is Daybreak Europe. I'm Lizzie Burden with your top stories. The trillion-dollar tech wipeout. Alphabet, Qualcomm and Arm all slide after earnings as concern mounts about the sector's massive spending on AI, with one tech ETF losing $1 trillion in the past 7 days. Meanwhile, oil tanks on easing geopolitical risk. The US and Iran confirm talks, but President Trump warns the Supreme Leader should, quote, be very worried. Plus, rates on hold. The ECB and BOE both expected to leave interest rates unchanged with a focus on the forward guidance. We'll bring you full analysis. Well, a very good morning. Welcome to Thursday. The picture in markets looks like this. The tech sell-off has been around the world. It continues in the Asian session. We've got futures lower in Europe as the momentum trade unwinds. But looking at Nasdaq futures, they are now in the green. The question, though, remains, have we reached peak tech? Now, outside of tech, attention squarely on precious metals. We have silver down 12%. It's been down 14% so far this morning, but plunging further despite the two-day recovery. We're going back to this historic market rout that started on Friday. With geopolitics in mind, we do keep an eye on oil, down for the first time in 3 days after Iran confirmed it will hold negotiations with the US tomorrow. So traders latching onto that rather than the tough talk. And we have Brent trading at $67 a barrel. Turning to the risk events on the agenda today, at the top of the hour, we'll bring you earnings from Shell and Maersk. Shell, like the rest of big oil, under pressure from weaker oil prices. So the question is whether it can maintain its buyback. And for Maersk, the focus will be on any comments on the reopening of the Red Sea, how increased usage of the passage will impact freight rates, which of course have already started to plunge. Then we turn to the double header in central banking. Both the ECB and the BOE reporting, both expected to keep interest rates on hold, and we'll bring you full coverage from London and Frankfurt. With that, let's set you up for the day ahead. We begin with breaking earnings out of France from BNP Paribas. The bank, of course, in the crosshairs of the political uncertainty in Paris and the fiscal risk that goes with that, though it was expected to get a boost from upbeat global trading conditions. They've reported unexpectedly high fourth quarter profit and raised some midterm financial targets. The CEO, Jean-Laurent Bonnaf, seeking to prop up this stock, which really has for a long time been lagging peers. You've got revenue higher in the period than expected, credit provisions lower, costs missing estimates, and we'll be speaking to the CFO of BNP Paribas, Lars Machenil. That conversation coming at 7 a.m. just after London time. Well, let's turn back to the tech sell-off, a global sell-off snowballing into Asia as anxiety over AI spending builds. Alphabet shares are down after fluctuating in extended trading following its earnings, which outlined an ambitious capital spending plan. Sentiment was further hit as Qualcomm and Arm also reported mixed earnings. The Alphabet CEO highlighting that Gemini's momentum is marked by strong enterprise growth.
Today, more than 120,000 enterprises use Gemini. Gemini Enterprise managed over 5 billion customer interactions in Q4, growing 65% year over year. Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year.
Let's get more on this story now with Mark Cranfield from our Bloomberg MLive team. Mark, it looks like this tech sell-off has been around the world, but Nasdaq futures actually now in the green. Can we say we haven't yet reached peak tech?
Not too sure. It's looking a little bit ugly here in Asia, and the poster child of the tech story, the AI story in particular, is the Kospi Index, Korean equities driven by people like Samsung and SK Hynix. And he's having a pretty rough day here in Asia, and it looks like it's going to end badly for the Kospi there. And that really is an indication that some of this so-called healthy rotation that we were seeing in recent weeks maybe is not so healthy after all now. So a lot of people are convinced that moving out of the AI software plays into the hardware plays was really the way to go, and that was sustaining the strength in some of these markets. But we're seeing a capitulation today in Korea, where even those people who previously have been immune to some of these shockwaves. They're falling as well. So this is likely to spread around the world. And because you're seeing it affecting stocks which are very popular in the retail space, that's spreading into crypto, it's spreading into silver, and across a variety of plays that people really like to do on a momentum basis. So we're now getting into the realm of just P&L management. People are seeing enough losses in the AI software space that they're having to cut positions in other areas as well. So it's really now just going across the board. You're seeing with Chinese tech as well, some very heavy losses in that area. So now we're getting to, it's starting to unravel. It's getting a bit unruly here. It's pretty much a case of people are not too concerned whether or not there's more life in the tech sector or not for the moment. They just want to square up positions and get back to a flatter situation as they assess what's going on in the world here. It's really become too volatile, too uncertain. Let's just come closer to home and see what happens for a few days.
Well, Mark, you mentioned silver plummeting again. It's currently down 12.2%, $77 an ounce. How significant is the $70 an ounce mark?
It's a very big level for people that have been following precious metals over the past few months. So if you go back to mid-December, that was the point when the precious metals market really took off. That's when the whole world noticed that there was something exciting going on for silver, platinum and gold. When silver went above $70, it shot all the way up to $121, somewhere in that area, in a very short space of time. We've come down fairly quickly. We have seen it down to about 71 earlier this week. But if we go below 70, that would be the first time for a couple of months. And that's probably where the last people who've got in, the short-term momentum players, will probably have to give up their positions, give up leverage, and you could see a fast acceleration there as people are forced, because of what happens in the futures market, because of liquidations, in terms of margin calls. It could get pretty ugly. So certainly for the rest of the world, that 70 line is looking pretty important now in silver. It could trigger movements in other asset classes, and that's maybe part of what we're seeing today, is that people anticipate it will happen. So it's affecting equities and it's affecting cryptocurrencies as well.
It is indeed. Mark, thank you for taking us through all of that. That's Mark Cranfield, Bloomberg Markets Live cross-asset strategist. Well, turning back to earnings now, we have had earnings just breaking from Volvo Cars, reporting revenue for the fourth quarter that missed the average analyst estimate. I'm pleased to welcome now to the programme Håkan Samuelsson, the CEO of Volvo Cars. Good morning to you. Thank you for making time.
Morning.
Just walk us through, please, the challenges that you've had in the past quarter and whether you're optimistic that things could improve.
Yeah, I mean, we have a very tough market. I mean, we see that everywhere in China, especially. We have incentives for electrified cars has been discontinued in US and China. So a rather tough headwind on the market. But I think what is important for us during this year, we have really made a reset of the company. We have been really good in lowering our cost position. We have been reducing 3,000 positions in our white collar organization. We have a leaner organization and really did the very challenging cost and cash action program we announced. We really finalized basically a year ahead and encouraged us to continue in the next year. So really good internal work, tough external. And at the end, we landed at a result that, of course, we are not satisfied with, but still, I would say, looking at the severe external factors is a reasonable result. And I'm really good. We are back to positive cash flow for the year. Was really the main number one objective we had with the year.
OK, so a really challenging backdrop, I understand. Specifically, how much has recent dollar weakness affected you?
Very severe, of course, for the US markets. I mean, the profitability money coming in from the US market took a big hit, of course, from this currency effect, and also with the discontinuation of the incentives we had earlier in US. So US has lost profitability with the currency.
But I know that you are moving output of your bestseller, the gasoline-powered XC60, to South Carolina. I know you have a plant there. You're already producing the XC90 and the Polestar 5. How much can that help to offset that dollar weakness?
It will, but it will take some time till we will ramp up that volume. But I mean, that is really the reaction to discontinuation of globalization. We're going into a more regional world, and then we have a more locally adapted products in China, and we are moving this car to South Carolina. We will introduce a second car later on in South Carolina. So we will go produce more where we sell cars, and I think that's really the right way to tackle currencies long term, as we need to have much more natural hedging. We cannot solve this with financial hedging.
I mean, you've also just unveiled a new long-range EV, the mid-size EX60 SUV. How have initial orders kicked off across Europe?
Very successful, and that's really a very important factor looking ahead. As you know, we have the ambition to really be an all-electric company. We should be ready around 2030. We will have, of course, hybrid versions for customers still not ready, but really a car for the most important segment is really the EX60, and it's also introducing some groundbreaking new technology. It really has a central compute we call the Hugin core computer. We have mega casting, we have battery cells directly to body. And we are also, I listened to your program about Google Gemini. We will be the first car launching that when this car goes into production. So that will also be part of this new car. So it's a really new beginning for us in the all-electric field.
You've alluded to it several times, Håkan, but of course every CEO that we talk to this earnings season is having to contend with this difficult geopolitical backdrop. I wonder, when it comes to the supply of chips, how you're preparing and protecting your supply chain against risks there.
I think we learned a lot during the pandemic, and it's really chips that we buy from sort of say tier 2 suppliers. You cannot just rely on the first tier 1 suppliers that they will have the chip. We have to go down all the way to the supply of the chips to our suppliers and really understand the whole supply chain. And that we learned, and I think that's the best way also to secure this. And of course also being sure that we have a good firewall between East and West when it comes to more advanced chips, because that's where the world is going into more and more technology restrictions, as you know.
And to what extent are you exempt from the rare earth supply concerns because your owner is Chinese?
Yeah, that could be an advantage. I wouldn't point it out as a significant advantage. I mean, we are using that in e-motors mainly, so permanent magnetic motors, but we also have other type of motors that does not require rare earth. So that is something I think we share with all other automakers. But of course, being owned by a Chinese is definitely not a disadvantage.
Something of a silver lining. Håkan, thank you so much for bringing us those results, talking us through them this morning. That's Håkan Samuelsson, CEO of Volvo Cars.
Thank you.
Well, still to come on Daybreak Europe, the ECB and the Bank of England delivering their rate decisions today. We'll preview both with Peel Hunt's chief economist, Kallum Pickering. That conversation at 6:30 a.m. London time. But first, President Trump warns Iran's leadership that they should be very worried ahead of talks. More details on that and the oil price moves next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, live from Frankfurt. Now, oil is falling for the first time in 3 days after Iran confirmed that it will hold negotiations with the US, easing the immediate risk of military strikes against the OPEC producer. It comes after President Trump sent this warning to Iran's leaders as US military forces amass in the region.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back. And look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wipe them out,
we have peace in the Middle East.
Yeah.
If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran.
Yeah.
They're not afraid of Iran anymore.
For more, let's bring in Bloomberg Horizon's Middle East and Africa anchor Jemana Basetchi. Jemana, it seems like traders are looking past that tough talk and focusing instead on the Oman talks tomorrow. What are the talks going to centre on?
Well, yeah, that's true, Lizzie. There's been a number of provocations this week, and at least the shooting down of that Iranian drone that approached the U.S. aircraft carrier, the Abraham Lincoln, a couple of days ago. And at some point, it did seem like it was touch and go whether these talks would actually take place. There was speculation they were going to take place in Istanbul, in Turkey. It looks as though Iran pushed back and actually demanded that they take place in Oman. And they've been pushing for the scope of the discussions this weekend to be centered more around their nuclear program as opposed to a broader portfolio of other items that the U.S. also wanted to bring to the table, including their arsenal of ballistic weapons and their funding of proxies around the region. But the fact that the talks is still taking place, they are scheduled to take place tomorrow, that's Friday, in Oman. The foreign minister will be there, the Iranian foreign minister, and there you have it. It's a post that he's put up on X saying nuclear talks with the U.S. are scheduled to be held around this time tomorrow in about 24 hours in Oman. On the U.S. side, it's been reported that Steve Witkoff is going to be flying to Qatar today to have talks with the Qatari Prime Minister and Jared Kushner as well. Unclear whether they're going to engage in talks directly with Iran, because so far, even last year, in the run-up to that U.S.-Iran confrontation, the talks were indirect. And so as we head into the weekend, you could say that the window for diplomacy is open, but I think expectations that this is going to yield anything substantial are also quite low as well.
Well, if they can't find a solution, Jemana, where does it leave oil? We're also, of course, keeping an eye on the Ukraine peace talks this week.
Absolutely. And there's a lot of geopolitical premium that is being priced in to oil right now. On one hand, you've got the fundamentals that would point to lower pricing because of the supply glut that so many analysts have been talking about, and the fact that Chinese demand seems to be somewhat leveling off, or at least their stockpiling activity. But the reason we're back up here, very close to $70 again, is this geopolitical premium. The real risk that if these talks don't yield anything, which again is a low likelihood at this point, then the U.S. could go down that kinetic option, so to speak, and go for a military strike. And certainly the evidence is there because they've built up this quote-unquote armada in the region. The aircraft carriers are there, F-35s, F-15s. They're building up troops in the region as well. And President Trump is warning the supreme leader himself to be very, very worried about upcoming steps. So perhaps all of this is just a means of buying time, of building up reinforcements in the region. Again, we don't know what the U.S. is planning, but you have to think, given the positioning of the military assets in the region, that a military strike is not completely off the table, hence why you still have that embedded premium in oil. But heading into the weekend, I think a bit of a breather, a relief coming through that at least the two sides are open to negotiations. And let's see whether Iran actually will make some concessions on their nuclear program, because they're coming at it from a position of weakness with their proxies around the region eviscerated, with their nuclear existing stockpile, as we know, taking a big hit last year, and then the economy also in a downward spiral. So there's a lot of pressure on the Iranian regime to come to a deal. We'll see if there's any daylight between the two sides.
Well, of course, you'll be across those talks for us in Oman tomorrow. Jemana, thank you so much. That's Bloomberg's Jemana Basetchi, and she'll be back with Horizon's Middle East and Africa at 5 a.m. London time tomorrow. Well, coming up on Daybreak Europe, the Prime Minister, the UK Prime Minister Keir Starmer, facing anger in Parliament, including from his own lawmakers. We'll get you the details next. This is Bloomberg. Now to some of the top stories we're following for you this morning. Prime Minister Keir Starmer faced anger in the UK Parliament yesterday over his handling of the appointment 18 months ago of Peter Mandelson as the UK ambassador to Washington, amid scrutiny of Mandelson's relationship with Jeffrey Epstein. Starmer was questioned about how much he knew of the relationship when he picked Mandelson for the job, with Labour members of Parliament describing the mood in the governing party as febrile and mutinous. Elsewhere, President Trump says he would not have nominated Kevin Warsh to lead the US Federal Reserve if Warsh had expressed a desire to raise interest rates. Trump told NBC News that Warsh wants to lower borrowing costs regardless of his own view. The comments could come up during Warsh's confirmation process, where the Fed's independence is likely to be a central topic.
Let's get to the Fed. Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high. Okay, we're way high in interest. We have now, with me and with all the money, I've always been good at money. And with all the money coming into our country, we're a rich country again. We have debt, but we also have growth. And the growth will soon make the debt look very small.
Meanwhile, President Trump has spoken with China's Xi Jinping in a call that covered trade and geopolitical flashpoints, including Taiwan, as both sides prepare for a planned summit in April. Trump highlighted new Chinese commitments to buy more US soybeans, energy and airplane engines, while Xi urged caution on Washington's planned arms sales to Taipei. Speaking with NBC News, Trump framed the call positively.
Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high.
And staying with geopolitics, European Union member states have reached an agreement on the framework of how to provide a €90 billion loan to Ukraine. EU leaders agreed in December on the broad outline of the loan, which included requiring purchases using the money to be made within the bloc unless the equipment could only be sourced elsewhere. Well, those are some of our top stories this morning. Just checking in on these markets. That tech sell-off has been around the world now. The Nasdaq having its worst two-day rout since October, yesterday breaching its 100-day moving average. And that really is a level that some analysts see as a harbinger for more losses. So let's take a look at the futures picture. We are pointing lower on S&P E-minis and in Europe on Eurostoxx 50 futures. But Nasdaq futures are now in the green, higher 0.1%. Already, though, we've seen hundreds of billions of dollars wiped off the value of stocks, bonds and loans of companies across Silicon Valley. But also here we look at the currency picture. Of course, we've got two rate decisions today from the ECB and the Bank of England, both this afternoon. The pound and the euro a touch lower against the dollar, both expected to keep rates on hold. But euro strength recently likely to be a discussion point at that press conference with President Lagarde. Just keeping one eye on Bitcoin here. We are edging towards the 70k a token mark. It's down more than 42% from its peak in October. So the risk-off mood spreading across asset classes. Next up, we'll preview those ECB and BOE decisions with Kallum Pickering. This is Bloomberg. Live from Frankfurt ahead of today's European Central Bank decision, this is Daybreak Europe. I'm Lizzie Burden with your top stories. The $1 trillion tech wipeout. Alphabet, Qualcomm and ARM all slide after earnings as concerns mount about the sector's massive spending on AI, with one tech ETF losing $1 trillion in the past 7 days. Elsewhere, oil tanks on easing geopolitical risk. The US and Iran confirm talks, but President Trump warns the supreme leader should, quote, be very worried. Plus, rates on hold. The ECB and Bank of England both expected to leave interest rates unchanged, with the focus now on the forward guidance. We'll bring you full analysis. Well, a very welcome to Thursday. It is 7:30 a.m. here in Frankfurt, and the picture in markets looks like this. That tech sell-off has been around the world. It continues in the Asia session, and we have futures lower in Europe as that momentum trade unwinds. But as you can see here, Nasdaq futures are now in the green. Outside of tech, though, silver is joining the sell-off and pairing earlier losses, but plunging nonetheless. We're down 10% now. So going back to that historic market rout that started on Friday, even if we had a breather for 2 days. But with the geopolitics in mind, you're looking at Brent there at $68 a barrel, down for the first time in 3 days. And this after Iran confirmed that it is going to have talks with the US in Oman. That's tomorrow. But traders really latching onto that rather than the tough rhetoric that we played you earlier from President Trump. On the front pages this morning, in the UK, we have The Guardian leading on the crisis engulfing the Labour Prime Minister Keir Starmer. MPs saying that his days are numbered amid this fury over the former UK ambassador to Washington, Peter Mandelson, and his links to the late paedophile financier Jeffrey Epstein. One minister, in fact, was telling Bloomberg that it was only the fact that Starmer's best-placed rivals have reasons to hold back from a challenge that Starmer's actually still in post in Downing Street. And this story is on the front page of the FT as well. They lead on one Labour MP describing the affair as the beginning of the end for Starmer, saying the mood in Westminster is toxic, and speculation mounting as well that Starmer's chief of staff, who promoted Mandelson's bid to become ambassador, could himself be ousted soon. If we flip over to the Wall Street Journal, finally, they've got Elon Musk's SpaceX seeking an early boost for shares. This after the rocket and satellite business makes its stock market debut later on this year. Now that it's merged with XAI, they're hoping they can skirt the traditional rules and be included in a major index a bit faster and get access to more capital. You can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which as ever, terminal subscribers can find by going to D8YB Go. Well, let's get back to the tech story, that global rout in tech stocks snowballing into Asia. Let's get the view now from Hong Kong with Winnie Xu. Winnie, what are you watching?
Yeah, morning, Lizzie. You can see that Asian stocks down for a second day, still that rotation away from technology shares, and hence Infotech here sector down about 3%. Leading losses also are the Korean stocks, with the Kospi down about 4%. So really overall quite risk off in our region. Also just want to flip the board and take a look at the broader market in Japan, because surprisingly that the topic's actually doing better than some of the other markets in our region, and that is partly helped by some positive earnings coming through from trading houses, pharmaceutical companies, as well as from Sony here. They saw shares jumping as much as 6% earlier today when they announced a profit margin jump of 22%, and also raising full-year forecasts on the solid demand when it comes to their entertainment offerings. And Japanese yen here stabilizing a bit after 4 weeks of decline, and also the 30-year yield down about 7 basis points after some solid demand coming through from the auction earlier today, signaling that the yields at these levels are still quite attractive. But we will be closely watching out for that election this weekend. Also flip the board and take a look at some of the Chinese stocks, because interestingly we are seeing that consumer names PopMart and also local cosmetics brand Maersk doing quite well amid this whole tech sell-off, and also helped by some expectation for more spending during the upcoming Chinese New Year. When it comes to the darker picture here, with gold miners dropping and really dragging down the overall benchmark that is coming off that big sell-off that we're seeing in the precious metals today. Back to you, Lizzie.
Winnie, thank you for the snapshot of Asia markets there. That's Winnie Xu in Hong Kong. Now, we're looking ahead to the rate decisions from the European Central Bank and Bank of England later on today, both widely expected to keep interest rates on hold. And for analysis, I'm pleased to welcome Kallum Pickering, Chief Economist at Peel Hunt. Morning, Kallum. So it looks like we're going to get a hold, let's start in Frankfurt, from the ECB. But what's more likely this year? Are we going to have a cut more likely or a hike?
My base case is still for the ECB to hold this year, but I think markets are right to sense this sort of about turn in the ECB's guidance. So late last year, we had policymakers suggesting, well, if markets are expecting the next move to be up, perhaps in 2026, that sounds about right. But then more recently, there's been some concerns about some disinflation coming through as a result of the strong euro. And I would keep in mind here, the Eurozone is still a very industry-heavy, export-oriented economy. You see the weakness still in Germany. We've had a long period of deindustrialization. And so I think if the ECB can start to form an argument that inflation may undershoot, exports are going to be weak, the euro strength is a problem. I think they might just be gently signaling to markets that if this story unfolds the way I just mentioned, they should be ready perhaps for a rate cut.
Well, yeah, when does the ECB undershooting its inflation target become a problem? How much does the euro need to appreciate for it to change the ECB's rate path?
Well, in my view, markets will sort of do most of the job. Policy is probably neutral to slightly easy in the Eurozone. There are no significant inflation concerns on the horizon, so bond markets will just adjust to changing inflation expectations. That on its own helps with easing financial conditions. The other thing just to keep in mind here is that if you get strong demand for Eurozone exports as part of a global upswing this year, which I think is probably base case for me, I don't see why euro strength on the back of demand for Eurozone exports should be a problem for the ECB. Put this a different way. If European consumers suddenly have rising purchasing power and European businesses see increased demand for their wares, why should the ECB try to stimulate against that? And I think this is going to be the internal logic. The point you make about how far does the ECB need to undershoot, I think if markets start to see inflation expectations, say, fall below 1.5%, I think then the ECB will be prepared to move. But I think close to 2% or slightly below, which is probably where we're going to be, I think that's going to be enough to keep the ECB on hold.
So that's exports, but Kallum, what about Chinese imports? Are we likely to see inflation divergence across the euro area economy if you see different levels of Chinese trade diversion and on top of that, different levels of fiscal spending?
Well, this is again where I see the point narrowly from the monetarist point of view to say, well, look, we at the central bank care about inflation at 2%. If it falls below, we should lower rates. Fine. But we need to factor in what's actually driving these trends. If we've got some positive supply-side dynamics coming from, say, a flood of Chinese imports or even a diffusion of AI, and we know that governments in the Eurozone are creating demand, principally in Germany with this 1 trillion stimulus, which of course was delayed last year, but we're still all looking forward to. Like, why not just let this story play out? Why not let fiscal policymakers just stimulate a little bit? Why not just let this supply side story play out and then see where things land? I think that's where the ECB probably is right now. The danger is if you start to see weakness in inflation linked to weakness in demand expectations. But so far this year, actually, the data on the PMIs, the GDP data we've seen so far, have all surprised slightly to the upside. So I don't think the ECB is going to be in a hurry here to lean against this story.
And Kallum, let's turn to the Bank of England, because the UK economy seems to be both strengthening and losing jobs. You've got unemployment at a 5-year high. Yeah. Surely, is this a time the BOE should be cutting rates?
Well, the two things that I would just point to is, yes, growth is improving, but it is below potential. That is to say, even at these rates of growth, we will be seeing an opening up of spare capacity. We see that in the labour market. The second thing is we've had so many huge base effects in the UK coming from external prices, coming from domestic policy choices, that the headline rate of inflation, which is currently above 3%, is not giving us a very good picture of underlying inflation dynamics. If I take a look, for instance, at monthly inflation prints over the past couple of months and I annualize those, the central bank is basically at its target of 2%. And with a bit of a lag, we're going to see headline inflation come down pretty quickly. The Bank of England itself is signalling that by summer we'll be at 2%. So for me, the danger is if you let this story of opening up capacity, weakening labour markets, inflation at target play out for too long, you're going to find that you undershoot into next year. I wish the bank actually had a little bit more courage to go a bit quicker. I think today they're on hold, but I think they'll signal the next cut comes in April.
Yeah, traders only fully pricing in one further cut this year, but you see 2 cuts. But I also, Kallum, want to turn to the politics. We've got to talk about the politics. It looks like Keir Starmer is hanging on by a thread right now by the looks of the polls and the talk in Westminster. We've got a fantastic write-up about it on the terminal. Would any of the potential candidates to replace Starmer boost growth? I'm thinking about Wes Streeting talking about offering a more pro-EU stance. Does that strike you as something that would really move the needle?
the two things holding the UK economy back today, this government is not prepared to address. The first thing is a chronic shortage of supply, which is holding back investment, it's holding back exports, it's holding back AI diffusion. That is a long-lived problem that we need to completely reorient our approach to energy to fix. The second thing is markets are not convinced that policymakers in the UK are sufficiently disciplined when it comes to sound money policies. This is why interest rates in the UK are higher than in any other country in the G7. The 10-year rate is 4.5. It's crept up over the last couple of days on this political story. Until we bring interest rates down to a normal level, that is, we get this so-called moron premium out, and until we fix this supply problem, we won't go back to sustained, healthy economic growth. Whoever replaces Keir Starmer, I don't see among the roster anyone seriously considering these two problems.
Well, would any of them bring about so much fiscal slippage, Kallum, that the BOE couldn't cut rates further?
I mean, the challenge with fiscal policy is, what's the problem that markets are concerned about? Is it the overall level of debt and the deficit, or is it the inflation risk? In my view, it's the inflation risk. And so whoever replaces Starmer, if we just persist with these anti-growth policies, but they're not inflationary. What are the anti-growth policies? A badly designed tax system, over-regulation in labour markets. That on its own shouldn't spook bond markets so long as inflation stays under control. The danger is that if you lurch, let's say, left, if you replace Starmer, you'll find then that more inflationary policies will get priced into bond markets, and then the Bank of England will have to offset this loss of credibility, these worries about inflation, by staying even more hawkish. Put this a different way, if we would have got the income tax cut that markets had expected back in the November budget, that would have been a very strong signal from this government that we really care about bringing inflation down, and we would not be talking today about whether the Bank of England cuts, say, twice this year. We'd be asking the question, can the Bank of England cut 4 or 5 times?
Easy for an economist to say, hey? Difficult when you're the politician. Kallum, thank you so much. That's Kallum
right.
Pickering, Chief Economist at Peel Hunt. So glad to have you on the programme. Well, that Bank of England policy decision is coming at 12 p.m. London time, followed by the press conference at 12:30 p.m. And we'll bring you special live coverage of all of it on the terminal, online, and for viewers in the UK and Europe on Bloomberg Television. Do also catch our interview with the BOE Governor, Andrew Bailey. That's coming at 4 p.m. London time. And here in Frankfurt, we'll bring you full coverage of the European Central Bank decision. That's at 1:15 p.m. And Christine Lagarde's press conference comes half an hour later. But coming up right here on Daybreak Europe, as AI concerns spark $1 trillion tech wipeout, mixed earnings from Alphabet, Qualcomm and ARM also hit sentiment. I'll bring you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Lizzie Burden in Frankfurt, where it's 7:46 a.m. Well, AI angst has helped wipe hundreds of billions of dollars off the value of tech stocks, not just in the software sector, but across the board. And sentiment was further hit as Alphabet, Qualcomm and ARM all reported mixed earnings. I'm joined now for analysis by Matt Bloxham, senior analyst for Bloomberg Intelligence. Matt, we've had mixed results, as I say, from Alphabet, ARM and Qualcomm, but what are the big takeaways for investors? Good morning.
Yeah, good morning. Obviously a better reaction to the Alphabet results, obviously parent of Google, compared to Qualcomm and ARM. And I think two different things going on there. Obviously, the really big news with Alphabet was the massive increase in capital spending for 2026, potentially $175 to $185 billion. So that would be essentially about double what they spent in 2025 and 3 times as much as the last 3 years combined. So huge increase. So the AI land grab or arms race is still very much on. between the likes of Google and Meta and Microsoft and others. I think in contrast, what the weakness we saw in Qualcomm and ARM reflects softness in the smartphone market, which is being heavily impacted by supply constraints in the memory space. And obviously both of those companies heavily dependent on the smartphone market for their revenue. ARM is pivoting into AI, but is still kind of taking time for that to kind of to crank up, really.
Now, Matt, I need you to play the referee here. We've had the NVIDIA boss, Jensen Huang, saying that the software sell-off is the most illogical thing in the world. Who's right, the market or Jensen Huang?
I have to say that probably in balance, I'm with the market right now. I mean, I think I saw the comments that Jensen made, and I kind of think it's a little bit the other way around. He was kind of saying that that these AI doesn't use the tools use AI, and I think he's kind of underplaying the kind of really quite profound kind of changes that we're seeing in how AI is actually shaping the tools that everybody in your own personal life and in business are using, and how that does create quite a big threat to even kind of relatively new software companies. And this kind of full industries, anything that's kind of human capital intensive, service intensive, is really exposed. And I think it's not surprising that investors said, hang on, we're having to rethink our AI thesis again, and the best thing to do whilst we figure out the next kind of part of this story is to take risk off, figure out a new strategy, and then come back into the market. Clearly, this sell-off is too broad, but I think it's going to take a while for us to kind of see markets pick their new winners.
Matt, thank you so much. That's Matt Bloxham from Bloomberg Intelligence. And we're going to be getting more insights on these tech earnings at 4:45 p.m. UK time when we speak to the Qualcomm CEO on the Bloomberg Tech Show. But now to some other top corporate news this morning. Bloomberg has learned that SpaceX held meetings last month with banks from outside the US as it targets a listing this year. Sources say one group was made up of European banks, while another included firms from around the world in other regions. We're told that Wall Street giants Bank of America, Goldman Sachs, JP Morgan and Morgan Stanley are already lined up to lead the listing. Elsewhere, Bloomberg understands that the biggest US lenders are pushing for a loosening of the European Union's cap on banker bonuses. Firms including Goldman Sachs, Citigroup and JP Morgan are pushing the cause during the EU's upcoming review of its banking rulebook. The UK has already dropped the restrictions which cap bonuses at 2 times fixed salaries in the spirit of freeing the industry from unnecessary burdens. Now, Danish shipping giant Maersk is expected to release its fourth quarter earnings before the market opened today. The company's plans to resume shipping in the Red Sea will really be the focus here as markets assess the impact. For more, I'm joined by Stefan Kovacev, who is Senior Credit Analyst at Bloomberg Intelligence. Stefan, good morning. Just walk us through how the Red Sea situation is impacting Maersk.
Good morning. I think the Red Sea situation has been a big positive for the industry for the last couple of years, but now more and more companies are going back into the Red Sea. So the big question is it safe for container shipping companies to go back in the Red Sea or not? Or will it be in the next 6 months, 12 months? Because when it does happen, we estimate that the available capacity in the system will increase by about 7 to 8%, because currently ships are busy going around Africa. They will have a direct route via the Red Sea. So more capacity can lead to lower freight rates and more headwinds for the industry and Maersk.
And how is the tariff story going to feed into these results today?
Tariffs are clear negative for the industry in general, but it's a very fragmented industry, and Maersk actually is a big player. They're number 2 in the industry with a market share of about 15%. And also their exposure to the US-China route is very small. It's about 5% of volumes for them. They also have a very strong balance sheet. They have about $26 billion of liquidity as of Q3. So I think they're very well prepared and well positioned, at least relative to peers, to face more geopolitical headwinds and tariffs this year.
Stefan, thank you so much. That's Stefan Kovacev, the Senior Credit Analyst at Bloomberg Intelligence. Well, you can watch the Maersk CEO Vincent Clerc unpacking the firm's fourth quarter earnings. That conversation on the opening trade at 7:30 a.m. London time. But we've got plenty more coming up right here on Daybreak Europe, so don't go anywhere. This is Bloomberg. our last few minutes here, a few terminal charts to set you up for the day ahead. At 12 p.m. London time, of course, we've got the Bank of England rate decision expected to keep interest rates on hold. And let's take a look at the unemployment backdrop, because the Bank of England really is in a tricky spot here. Policymakers weighing contradictory signs that the economy is both strengthening and, as you can see here, losing jobs. Unemployment at a near 5-year high. But then in the afternoon as well, we're turning our attention over to the European Central Bank, also expected to hold rates. You remember not so long ago there was talk of hikes after comments from Isabel Schnabel, the market reacting to that, but now it's faded for various reasons. So flip the board over. First of all, we've had inflation dipping below the 2% target. Second, we've seen euro strength on the flip side of dollar weakness, so the euro briefly pushing past that 120 threshold last week, and the danger here being that it could damp exports or embed the inflation undershoot more permanently. And then, of course, thirdly, since the last policy meeting, you've had the Governing Council having to consider President Trump's tariff threats over Greenland. So if we flip over one more time, you can see the top two lines on the next chart. Here we go, reflecting that heightened uncertainty around US policy and geopolitical risk in the eyes of economists. So given all of those downside risks, I doubt President Lagarde's going to be adding fuel to the fire with any hawkish rhetoric today. Turning to the other risk events on the docket today, aside from those two rate decisions, we've got earnings from Shell and Maersk in just a few minutes' time. Shell, like the rest of big oil, under pressure from weaker oil prices, and Maersk, the commentary will be focused on the reopening of the Red Sea and how it impacts freight rates. Of course, they've already started to plunge. And the CEOs of both of those companies are going to be speaking to Bloomberg TV later on, so don't miss those. But also stay with us for special coverage of the Bank of England decision, the press conference, and straight after that, the ECB decision and President Lagarde's comments. But that does it for Daybreak Europe. The opening trade's coming up next. This is Bloomberg.